class, and welcome to the video lecture for Accounting for Bad Debts. The third learning unit covers recording recovered debts after an account has been written off and the direct write-off method of accounting for bad debts. In this example, a customer's account was previously written off because the business determined it wouldn't be collected. So what happens if the customer does end up paying? First, we need to put the accounts receivable back on the books. We increase accounts receivable with a debit, and we decrease allowance for doubtful accounts with a credit. We're decreasing allowance for doubtful accounts because we no longer need that amount reflected in the allowance account. Next, we record an increase to cash with a debit and a decrease to accounts receivable with a credit. Notice this is a two-step process. You may be tempted to combine this into one journal entry, but by using two journal entries, you've made it more clear what happened in case you need to reference the transaction later. This is what's referred to as leaving an audit trail. So far, we've been using the allowance method to account for bad debts. There is another method called the direct write-off method. It's used when a company can't estimate the amount of bad debt expense, such as when a company is just starting. Using the direct write-off method, customer accounts are written off directly, and no allowance account is used. It should only be used if absolutely necessary because it doesn't match expenses with revenues. In this example, a customer's account was deemed uncollectible, so the business debits bad debt expense and credits accounts receivable directly. We did not make any kind of adjusting entry. Now we have a situation in which the customer paid, but the account had been written off in a previous year. The first step is to reinstate the customer's account with a debit to accounts receivable. But in this case, we don't credit allowance for doubtful accounts because we're using the direct write-off method. Instead, we credit an account called Bad Debts Recovered. Bad Debts Recovered is like a revenue account and is listed on the income statement in a section called Other Income because it's not sales revenue. The next step is to record an increase in cash with a debit and a decrease in the customer's accounts receivable account with a credit. If the account was paid in the same year, there's no need to use the Bad Debt Recovered account. We simply reverse the write-off journal entry done previously as if it never happened. Now I'd like to do a problem in the textbook, problem 13B-4 on page 513. Grand Company, which used an allowance for doubtful accounts, had the following transactions in 2012, 2013, and 2014. Use the income statement approach. A says journalize the transactions. Okay, so December 31st, recorded bad debt expense of $12,400. This is our adjusting journal entry. Since we're using the income statement approach, we can use the full amount. If the problem had said we were using the balance sheet approach, we'd need to know how much was in the allowance account. So A, we're going to debit bad debt expense for $12,400, and we're going to credit allowance for doubtful accounts for the same amount. April 3rd, wrote off Edward Innes account of $4,200 as uncollectible. Since we're using the allowance method, not a direct write-off, we debit allowance for doubtful accounts, not bad debt expense. So we have, this is December 31st up here. Sorry about that. Okay, so we have April 3rd. So we're writing off his account, and when we use the allowance method, we don't debit bad debt expense, we debit allowance for doubtful accounts. And the amount is $4,200. We're going to credit his accounts receivable. That's Edward Innes, $4,200. I'm using the abbreviation AR for accounts receivable. Okay, June 4th, wrote off Robert Thompson account of $2,600 as uncollectible. So this is the same kind of journal entry. June 4, so we debit again, allowance for doubtful accounts, $2,600. And going to credit accounts receivable for Robert Thompson. Okay, August 5th. Recovered $520 from Robert Thompson. Now, we just wrote off his account, so we'll need to reinstate it for the amount that he paid. Remember, we're using the allowance method. So we're going to put his accounts receivable back on the books with a debit to accounts receivable of $520 and a credit to allowance for doubtful accounts, $520. Okay, and so notice this is like a partial reversal of the original write-off. So now we journalize the second part, which is the receipt of cash. So we debit cash for $520 and credit his accounts receivable for $520.
Part B says, journalize how Grande Company would record the Robert Thompson bad debt situation if the direct write-off method were used. This means we don't have an allowance account, and back on June 4th, our entry would look like this. We'd have a debit to bad debt expense, for $2,600 and a credit to accounts receivable, Robert Thompson's accounts receivable. Now on August 5th of the following year, $520 is recovered from Robert. Since it's the following year and the original write-off to bad debt expense had been closed out to net income, we reinstate Robert's accounts receivable with a debit, but we credit bad debts recovered, not bad debt expense. So we reinstate his accounts receivable for the amount that he paid, which is $520, and we credit bad debts recovered. We still have to record the receipt of cash. Remember, this is a two-step process. So we debit cash for $520 and credit accounts receivable for $520. So again, this transaction happened in 2013, and then the debt was recovered in 2014. So we use bad debt recovered. So that concludes Learning Unit 3 and the chapter. I'll see you again in Chapter 14.